If you want to stay broke for the rest of your life as a European, this video is for you. I'm going to show you the exact blueprint for financial failure. A step-by-step guide on how to destroy your wealth and ensure you never build any meaningful savings. Doesn't that sound exciting? The thing is, I've actually made some of these mistakes myself, so I'm speaking from painful experience here. Because sometimes knowing what not to do is more powerful than simply being told what you should do. If you're new here, my name is Angelo, and for over 8 years I've been investing in low-cost ETFs with my wife, with the goal of achieving financial independence one day. And in those 8+ years, I've learned that the first and most important step to staying broke is to get your investment ideas or advice from the wrong people. On a personal level, this could be your friend who only started investing recently and managed to double his money by betting on a single stock or another high-risk investment within a short amount of time. Since he's now feeling like a genius and is proud of what he achieved, he tells everyone about it, including you. Inspired by what he managed to achieve and calculating what those high returns could mean for your own savings, you ask him what he would do if he was starting over and put his investment plan into action right away. After all, why would you take the slow, boring road to building wealth when you can take a shortcut? Well, 3 months later, you are down 60% and your friend has mysteriously stopped talking about how smart of an investor he is. Turns out it was luck after all. Who could have known? For every success story, there are countless others who tried the same approach and lost everything. But since people never brag about their failures, you rarely hear those stories. My wife and I learned this lesson the expensive way in early 2019. A close friend had doubled his money with automated forex trading within a year and told me about it. Without fully understanding what we were getting into, we blindly trusted his experience and invested some of our own money. And after seeing great returns at the start, we felt encouraged and added additional funds, only to ultimately end up losing a total of 10,000 euros when things went south. That painful lesson taught us to never blindly trust anyone's investment advice without fully understanding it and the risks behind it ourselves. But sadly, friends aren't the only terrible source of investment information. A lot of investment advisors at traditional European banks aren't that much better, at least not in Austria where I live. That's because they have a strong financial incentive to get you to buy one of their bank's funds with 10 times higher yearly management fees instead of a low-cost ETF, because they receive a percentage commission of up to 5% of the money you put in. The more you invest, the more money goes into their pockets. That is why they're so eager to call you and help you for free after noticing you have all that cash sitting in your bank account, which could be put to much better use. So always make sure you fully understand the real incentive whenever someone recommends doing anything with your money. The second foolproof way to guarantee financial failure is to not even think about investing. 2 fantastic ways to achieve this are: first, spend everything month after month and live paycheck to paycheck. After all, we all want to impress the neighbors whose first names we don't even know. That way you ensure you get that heart rate nicely up and running if you suddenly lose your job or your car breaks down. I think we can all agree that's way better than cardio. Wait, you even managed to get your net worth below zero by using buy now, pay later services like Klarna to pay for the latest iPhone or your daily food delivery? Chef's kiss, you're definitely getting bonus points for that. And second, if you have money, keep it all sitting on a bank account for safety. It's the only way to guarantee your money loses purchasing power to inflation year after year. If you live in Austria like me, congratulations, you're in the right place, as we managed to keep our inflation at over 4% per year, more than double the Eurozone average. We are the champions. And since your uncle never made money whenever he touched the stock market, you're convinced it's just a casino for rich people. After all, you only lost 39% of your purchasing power to inflation over the last 10 years. That's not even half. How much better could things really have been investing in low-cost ETFs? Plus 182%? No way that's true. Even if it is, it's definitely going to crash again soon, which is all the confirmation you need to know you made the right decision. Speaking of low-cost ETFs, you can find my favorite brokers in Europe linked down below, which is a great way to support me as I don't do sponsors. But maybe you're thinking, Angelo, keeping money in the bank is too slow. Surely there's a faster way to lose money. You are absolutely right. And that brings us to step number 3. Chasing get-rich-quick schemes. For example, perhaps you've been thinking of adding a small Bitcoin allocation to your portfolio, which is plenty of risk on its own, don't get me wrong, but at least it has come back stronger from every single crash so far over its 16-year history. However, you're now convinced that it's too expensive, since it has gone up so much already. So you put your money into a currently trending meme coin instead because its unit price is cheaper, and because you've read news articles of people getting rich doing that on other occasions. Well, too bad. It seems like you picked the wrong one and your investment went to zero. But maybe cryptocurrencies just aren't your thing. No problem, there are plenty of other ways to lose money. How about unregulated peer-to-peer lending platforms promising yearly returns of 12% or more? After all, they offer a buyback guarantee. What could possibly go wrong? So of course, you end up moving your savings there instead of keeping them on a high-yield savings account, as that is only paying a measly 2% per year on your euros. Then, seemingly out of nowhere, the platform suddenly shut down and stopped withdrawals. All of a sudden, the background they had on their homepage makes perfect sense. Turns out they were planning to sail off with their investors' money all along. All jokes aside, I lost around 3,000 euros there myself and learned a painful lesson when it happened 5 years ago. This and similar cases, as well as the high risk for peer-to-peer lending in general, even when regulation is involved, is why I ultimately decided to fully exit the sector 2.5 years ago. Now, if you're curious about the fastest way to turn a small loss into total devastation, which I'm sure you are, we need to talk about the use of leverage. Let's assume you're considering well-diversified low-cost ETFs. As you heard, they could be a great option to build wealth over decades. After doing some research, you decide to only focus on the S&P 500, covering the US market instead of a global ETF, since US stocks have recently been outperforming the rest of the world. But even then, a long-term historical average of 10% per year just sounds a bit too slow to you. So of course, you go with a 3x leverage S&P 500 ETF instead. After all, why take 10% if you can aim for 30% returns on average? Well, damn, it looks like you picked the wrong year for your genius strategy. While the normal S&P 500 finishes 2022 down a painful 13.3%, your 3x leveraged version crashes as much as 54% by year end. You now needed to go up 117% to simply break even. Ouch. Here's the scary part. With 3x leverage, a 33% market drop within a single day would wipe you out completely. Sure, we've never seen that happen before, but when it comes to your life savings, are you really willing to take that risk? But even if you stick to regular, non-leveraged ETFs, there's still one guaranteed way to turn profits into losses: letting your emotions drive every investment decision. When your ETF portfolio crashes 30% in 2020, you immediately sell everything. After all, your friends and other inexperienced investors on Reddit are all saying we're definitely going lower. You hate yourself for ever investing in the first place. Your grandma was right after all when she told you Wall Street was a scam. And now you have 30% less money because you didn't listen. But the story doesn't end there. You spent months watching the market from the sidelines, hoping to confirm to yourself that you made the right call. But somehow, the market keeps recovering and climbing higher month after month. You tell yourself, there's no way this is going to continue. Just look at everything that's happening around the world. I'm sure it's going to crash again soon. It does not. Less than 2 years later, the market is up 84% from where you sold. Realizing your mistake, you want back in, as you don't want to miss out on this historical rally anymore. Due to your 30% realized loss and the market's incredible performance since then, you're sadly only able to buy 54% of the shares compared to last time, which definitely sucks. But you learned your lesson. This time will be different and you're going to hold no matter what. And yet, only 3 months later, as the market dips 10%, you end up panic selling once again. Congratulations, you've just perfected the art of buying high and selling low. The most reliable way to destroy wealth in the stock market. After a few cycles of panic selling, you're convinced that traditional investing doesn't work for you. So it's time to chase whatever is hot at the moment. Like Katie Wood's ARK Innovation ETF in 2021. After all, disruptive innovation is the future. Ouch, it crashed 80% from its peak and still has a long way to recovery several years later. Or maybe you felt like buying a green energy ETF would be a no-brainer, since the EU is constantly talking about investing trillions into the sector. Yeah. Strangely, that didn't turn out to be the right call either. And let me guess, now you're focused on European defense stocks, right? What could possibly go wrong? So there you have it, the complete blueprint for staying broke as a European investor. You've now listened to the wrong people, avoided investing altogether, chased every shiny get-rich-quick scheme, used leverage to multiply your losses, let emotions destroy your returns, and jumped on hype trains just in time to watch them crash. Congratulations, you've successfully turned what could have been a simple path to reaching your financial goals into a spectacular journey of wealth destruction. But here's the thing, I've made a few of these mistakes myself over the years. Some of them were painful, expensive lessons. If you did as well, don't be too hard on yourself. Just make sure you learn from them. And don't double down by taking even more risk to quickly try and make back the money you lost, as that is likely to only make things worse. The investing strategies that tend to work are usually boring, like just buying and holding a well-diversified low-cost ETF long term. They don't make for exciting dinner party conversations or impressive social media posts, but they have so far proven to be great options to build wealth over the long run, which I'd argue is the only thing that really matters when you look back in a few decades. So keep it simple. For example, by buying a global ETF on a monthly basis as we do, save and invest consistently regardless of market conditions, and most importantly, ignore the noise and all the shiny opportunities and just stick to your plan. I am confident your future self will thank you for choosing the boring path to building wealth instead of the exciting path to staying broke. What is the worst mistake you have made on your investing journey? I'd love to know in the comments. You can find the links to my favorite low-cost brokers for ETFs in Europe linked down below, which is a great way to support me if you'd like to. Apart from gently tapping the like and subscribe button if you enjoyed this video as much as I enjoyed adding a bit of humor and sarcasm for a change. Please don't forget that none of what I mentioned today was meant as investment advice. I'm just openly sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching. Have a wonderful day, and until next time.